Good morning, everyone. Thanks so much for joining us today for today's webinar, Firm Value and Succession Planning, Building a Financially Resilient Future. My name is Claire Hepburn, and I am the Deputy Registrar at the OAA. We will begin today's webinar by acknowledging the land on which we are meeting and calling in from. For millennia, the place we call Ontario has been inhabited by Indigenous peoples and nations who have been stewards of the land and are deeply connected to its rich cultural and natural landscape. We would like to invite you in a moment of reflection to acknowledge our shared responsibility to address past and present injustices and provide space for Indigenous knowledge and worldviews to shape the architectural landscape of Turtle Island. So just before we begin today's webinar, I want to share some important housekeeping items with you. We will be recording this session for quality and educational reasons. To have a stable internet connection, we do mute all participant microphones and disable for video feeds. However, we do very much encourage you to participate through the Q&A window. So at any point during the presentation, if you have a question, please write the question, submit it through the Q&A window down. You'll see at the bottom of your Zoom screen. We do reserve the Q&A period for the end of the presentation. So just note that we will be answering those questions, or Elaine will be answering those questions at the end. And those of you on the call today who are looking for continuing education learning hours, you do need to have a minimum of 80% attendance to have those hours accredited to your transcript. And we will upload those hours, just allow for a week or so for us to process that. We also offer closed captioning in multiple languages. And finally, please note that our presenter today does not provide any insurance, legal, or practice advice, and the OAA does not bear responsibility for errors or omissions in the discussions during the webinar. Now I am excited to introduce today's speaker for our session. Please welcome Elaine Pantel.
Thank you, Claire. Welcome, everybody. How we think about succession planning in the architecture industry is changing. It's about understanding that leadership, knowledge, and value are already moving through the firm. In my consulting work with architecture and design firms, large and small, I've seen that clarity around a firm's value emerges through the information that already exists in the firm, financial and operational, and through the knowledge and leadership held by its people. Today, we're going to explore how you can use that information to shape the story. We'll look at key drivers of firm value, both quantitative and qualitative, and we'll talk about how to bring those together in a succession plan that supports both the future of your firm and the people who make it what it is. Using a case study, EFP Studio, I will guide you through the learning process. And the goal in our case study today is to prepare and present an offer to sell shares to key employees of the firm. I'll take a moment to introduce myself so you have some context for the approach I'm bringing to today's session. My background includes many years of working closely with firm leaders, helping to align strategy, financial management, long-term ownership plan, and in more current years, a focus on overall business transition for the firm through the arc of its life. Today, I have a few poll questions to learn more about who you are and how I can enhance and elevate your knowledge. So our first question, which of the following best describes your current role in your firm? Take a moment. We'll show the results when we have a good number of responses. Okay, so let's take a look now. Excellent. So 60% of those who responded are currently owners or partners in a firm. And then another 18% are senior and perhaps moving into ownership. This is excellent. This is what I had anticipated. And this will be a very interesting conversation today. Thank you. In 2023, the RAIC and Canadian Architect Magazine collaborated and published the Canadian Architectural Practices Benchmark Report, identifying key challenges and trends in the industry. We know that the architecture industry is at a pivotal point, and I see that the mindset is shifting in many relevant ways. It's a time of innovation, collaboration, and new ideas. Plans for firm growth and development are moving forward. I'm feeling very optimistic about the opportunities and see the challenges woven into that scenario. There is a chance for some very creative thinking. Here's our case study, EFP Studio. We'll follow the arc of a typical project plan, building knowledge for yourselves as leaders of your firms. And I'll weave this through our presentation today. Here's some information about EFP Studio, a 42-person firm in Toronto, annual $7 million in revenue, 2 founding principals, planning an internal transition. So here's our timeline. 2024 to 2026, these years to understand the value of the firm and strengthen the firm to prepare for a sale of shares to key employees in 2027. So here we are where the firm was in 2024 when this project was undertaken. A note regarding the size of the firm for our case here. I would like to stress that concepts that I'm presenting here are applicable to firms of all sizes. The scope and depth of the analysis will depend on each firm's unique circumstances. And here's the ownership plan. That on Jan 1, 2027, each of the founders will sell off 6%, and the offer will be made to 3 key employees. So data and information flow through the firm, something that I mentioned at the start. Dashboards are a way to link the data to strategy. You can distill the information contained in the firm's financial and information systems and use visuals to focus attention. And there's a lot of creativity here. These can be customized for clarity and action. It's to help us focus on what is really critical and the relationships. Here is a framework. This is the visual breakdown of revenue at the top down to profit at the bottom. So this model highlights the key elements and components of the firm's operations for an architecture firm. It's useful to use this to understand where the key performance indicators, which I'll call KPIs, apply and what we're actually measuring. Something to note here that it is net revenue that we base our measurement of performance and calculate our metrics against. Some firms carry significant amount of sub-consultants, and so we focus on net revenue as the firm's fees. And then we also importantly look at the allocation between direct labor and other indirect labor. Now, some of you may have this breakdown in your systems, which provides you a chance to go deeper into understanding your performance, and some firms don't. So knowing this, it will change the amount of information you can get. However, I think I'm seeing more and more firms investing in the platforms that can allow labor to be allocated in more detail. So here is the initial slate of operational KPIs. As you can see, we're focusing on metrics linked to net revenue, direct labor, and staffing, and profitability. We're measuring many different aspects: sustainability, efficiency, productivity, value. Many of these are comparable to industry benchmarks. And when we go through this exercise for the case, I'm going to be using these top 5 KPIs for our dashboard. Here is a slate of some business development KPIs that firms are using and are also out in public surveys and so on. So this provides forward-looking information, can help the firm's leaders in strategic planning, business development, also building in the information into the firm's cash flow scenarios, understanding future revenue, staffing needs, and workload. So it's not only related to business development. These are helpful in strategic planning. So it's most important if you're looking at benchmarks, and some of you may be using these in your firm, is to track your firm's performance over time. Internal trend lines are very useful to provide feedback on the effectiveness of operational and strategic decisions. I ask that you use caution when you're comparing the firm's results to survey and other data, because the differences in how KPIs are measured can have a material impact. For example, I'll give you a classic example is the components of direct versus indirect labor. I've had discussions with clients, with the finance people in architecture firms about what do you group in direct labor and what do you group in indirect labor? Are the timesheets and so on accurate and so on? So if that's different in one firm versus another, some of these key metrics of those top 5 will come out very differently. So I suggest that if you're looking at surveys, and I've listed a few here, look at the trends in the data, because the trends in the data are sort of more macro indication of what's happening in the industry over time. Discussing trends in the firm's KPIs over time builds knowledge, and it builds trust, and it creates openings for new thinking. So you can use these dashboards of KPIs to guide coaching and accountability. I really love the concept of who takes ownership for each KPI. There could be champions in the firm that take on these roles. And I find that in any aspect of business or other organizations that I'm involved with, asking questions is a very powerful tool to use when you're trying to stimulate group discussion and gain unique insights into possible action points from all the voices in the room. So before we get into the dashboard for our case, I have another poll for you. How confident are you in interpreting your firm's financial reports and key performance indicators? Seconds. Okay, let's take a look. Excellent. Thank you for those of you who responded. And this is this is actually encouraging to me, because I'm seeing over time now that, like, this area here, somewhat confident, is at 42%. This is growing. And that's very positive, and I'm not surprised to see that. In terms of being very confident, often there are leaders they may be financially oriented people, could be, depending on the size of your firm. Comes back to that concept of a champion, like someone who really gets the data, and others are focused on other things. But the fact that the learning curve is improving, leaves me very confident. However, it is interesting to note that there's definitely room for growth here, and there's definitely room for learning. So I'm going to present to you a very high level dashboard to start the conversation. Okay, so we're now in part 1, and we're going to look at the financial dashboard in our 3-year planning cycle, 2024 to 2026, to prepare for a sale of shares in fiscal 2027. Here's a snapshot of where the firm was in 2024. You can see the firm is doing well. We'll start here in the financial results. Net revenue, $7 million. Profit before tax, $600,000. Allocation of direct versus indirect labor. It tells us at a big level, a high level, the firm is doing well. Then we look at the relationship of the factors here. We get a lot more information, and we get the story, the beginning of the story, chapter 1. We're measuring change in net revenue. In this case, this is our baseline year. The net labor multiplier, which is the relationship of direct labor to total net revenue, it's 2.8 times, which is healthy. Utilization rate is that the percentage of total staff time spent on projects, also within a healthy range. Net profit margin is good. It could be, depending on the type of projects and so on, there could be room for growth here. And another very common metric is net revenue, which is this number divided by the number of full-time employees or equivalents. Also good, very, very good. So what we want to do here is talk about where we're going next. A note on benchmarks and targets. Also a note of caution, similarly to a survey data, that these are compiled from various surveys and other industry data that I've seen. And I've had discussions with clients about the benchmark versus the target. So some firms are tracking these surveys, so they have the story of data over time, and also setting internal targets that are, a bit of a stretch, some stretch goals and so on, and creating some room for growth. So what strategy did we set in 2024? What are the action points? It was very deliberate. And we did find some champions in the team amongst the leaders, the owners, and senior professional staff. And also in some cases, depending on who your finance person, if there is like a controller or CFO, or even a bookkeeper can help champion some of the data collection. So, and we set quarterly meetings to review outcomes. This is really great because it takes time to learn. There's a learning curve. And we look at this idea of levers, that if there's one area that you're going to focus on and you can make a small change, and I've seen it shown at some presentations, let's say a 1% change in an area can have an outsized impact potentially on the firm. It will gain a better understanding about how to track the impact of our plan. So let's see what happened. So we're now in 2020. We're in this timeline where you know where we are expected to be at the end of 2026. And what we've seen here, this is again the revenue to profit statement. Good big picture, growth in net revenues, growth in profit before tax. And we see the average of these 3 years, $800,000. Park that because we're going to come back to this when we look at a pricing model. We see that labor costs are increasing as the firm grows, and we're also seeing overheads are increasing, which is not a surprise either because the firm is making investment in technology, in staff development, professional training, leadership development, so on. Infrastructure of the firm, critical infrastructure. Now here, though, we have the presentation of the dashboard for those 3 years, and we get a much more detailed view. So we're seeing that net revenue has grown very well, very quickly, in fact, over those 2 years, which means that the pipeline, the projects, some of the business development is working very well. And at the same time, we're seeing that the profit margin is moving in a positive direction, however, more slowly. And this is not unexpected necessarily, because here we see that the firm has grown in staff from 43 to 51. And that's an investment. The investment may take time to translate into profit. Utilization is holding at 60%, which is great, which means that 60% of professional hours are being devoted to projects. And the multiplier is inching up closer to 3.3 times. And that is very, very positive. So all in a positive direction. And it's good. This is steady, sustainable growth. And so we're going to take that information. We're continuing with our strategy, but now we want to get ready to prepare the offer. And in order to do that, we have to take a broader look at firm value and look at a pricing methodology for the architecture industry. Value is a broad concept. There are quantitative factors, financial information and performance. We can look at revenues and profits and cash flow from a financial perspective. And there are many qualitative factors that start with an awareness of what these could be and find out that we can find a way to measure. Quality of revenue is qualitative as well. What leads to profits in terms of our staff team and so on is also qualitative as well. And then we come to this concept of the business advantage. You may have heard the term goodwill. I like this term. It's unique in that it expresses the fact that what is the advantage for your firm? What is unique? Many firm leaders have a gut sense of what this could be, how the firm is performing, what contributes to this advantage, the reputation, the niche areas. There are many awards and other ways that public knowledge and awareness of the firm happens. And so these are many, many factors that contribute to value. So now we have to try to harness all that knowledge and information into something that's applicable and usable. Which brings us to a pricing methodology. So I'm going to walk you through a very informal framework and process. I do have to mention here that there are some cases where firms will hire a certified business valuator who is licensed to issue a certified valuation on the value of the business. And I've seen cases where that has been requested, and either by the owners, by people buying in, and so on. It's a costly and time-consuming process. It's really a decision in each unique case as to whether you want to go for this, and whether you have to go for this, and so on. I find that this internal informal process is part of the learning. It provides education. It's a step-by-step process. And one way or another, where you're going to want to end up is on a methodology for the share price, not just for the initial sale, say, but something that can potentially be embedded, perhaps a formula in the shareholders' agreement, and provides a basis to be used for future purchases and sales. What common methodology for architecture firms that we see here in Canada is a combination of two factors. The value is expressed as a combination of what we'll call book value and additional value. At a high level, book value is derived from the firm's financial statements. And this concept of additional value, which we expressed as a qualitative set of factors, can be based on the firm's profits over time. So the ability of the firm to generate profit over time, plus taking into account a lot of other like qualitative factors, will act as not a proxy or a basis on which this additional value can be quantified. So the calculation of additional value is based on the firm's profit over time, expressed as with a multiple. A multiple of profits is something that you may have heard about. It's used in public stock markets as a price earnings ratio. In private industry, the multiples are often lower than, say, in public companies or tech industry and that kind of thing. And when we get into a licensed, regulated profession like architecture with provincial licensing, then we're looking at a very different set of realities, but the concept is the same, and that the multiple will help express the value. Well, let's continue. A little bit of a deep dive here. We start for book value with the financial statements. Now, I'm not going to get into technical terms here. It's not a requirement for you as leaders in your firm to know how to read financial statements. Some of you are very proficient in this area, financial statements and reports and detailed P&L and so on. You love this. Others are focused on other things. We all have our own skills. It's not a requirement to know. However, I feel that it's important to have an awareness and to have that knowledge in the firm so that you can focus on the key components. And you can have a financial advisor interpret and clarify these concepts for you. It's just really important that a lot of the firm's book value, or what's reflected in its financial statement, is tied to accounts receivable and work in progress. Generally, that's a good indicator of what you would expect to see the financial statement retained earnings balance land at. So sometimes I presented this as an idea of the level of your accounts receivable. That's a simplification. Now, additional value, this business advantage or goodwill, what's really interesting here is that for you to know is that under accounting standards, a company or a firm's own potential goodwill value is not reflected in its financial statements. It's not permitted to be reflected in the firm's financial statements. And as an aside, if you do see a goodwill line in a set of financial statements, could be because that firm, that company bought some assets or bought a firm which contains some goodwill. So we're calculating this business advantage as a separate component to book value. So coming to this additional value, I mentioned this multiple of profits approach. So we start with the firm's annual profit before corporate taxes, assuming you're a corporation, or if you're a partnership, it's annual profit. And we go through an adjustment process, or what's called normalizing. You may have heard this term. It's to adjust for unusual, non-recurring items that don't really reflect the firm's, quote, normal business operations. Examples, classic examples could be owner compensation to adjust it to market level. There could be, I've seen a year where there was a major move of the firm. There could be rent being paid on the space that is in a building owned by some of the owners of the firm. That's a related party transaction, and so that might need to be adjusted to market value, and so on. The key to note here is that they're often, when I go through this exercise with clients, and when I've looked at reports from certified valuators, there are often, the number of normalizing adjustments, they have to be pretty high level things. The key is to not get into too much detail or in the weeds. It has to be something very unusual that impacted that particular year. Then so we've done this on a year by year basis. The next piece is to decide on how many years we're going to look at in this multiple of profits approach. 3 to 5 years is common, and the averaging is meant to average out volatility over time. It's a moving average as you're pricing the firm over time. And then we multiply that average profit by an agreed multiple. And I'm giving you some context here, the range of 1 to 4 times average normalized profits for small to medium-sized firms. And another caution here, when you're talking about multiples with colleagues or other business contacts, or if you're in a negotiation, I strongly suggest that you ask for or try to understand more deeply how this multiple was approached, what the valuation formula is. This formula that we're using here, which is book value plus additional value, is very tailored, informal basis for a particular firm. And especially when we're looking at an internal value, an internal succession strategy, it's really important that we understand that the accounts receivable or book value is very unique. So some firms will take the entire price as a multiple and not break it into these two components. So that being said, we're going to move back to our case, EFP Studio, and develop a price range for the firm. So I'm presenting you with 3 scenarios. So we're assuming here that the book value or the accounts receivable roughly of the firm at December 2026 is $1.5 million. So that stays. Now we have, for the additional value, we've decided we're going to average 3 years normalized profit. And I'm going to present pricing using 3 different multiples, 1, 1.5, and 2. Well, let's see how that factors in. So here we go. Book value, 1.5 million. When we went through the dashboard, the 3-year dashboard, 2024 through 2026, we had $800,000 of average, what we'll assume normalized profit. So that's the same in the formula. What's changing is the multiple. The multiple of the average 3-year normalized profits. 800,000, 1.2, 1.6. Total value, book value plus additional value, we're running from 2.3 to 2.7 to 3.1 million. And I often like to reflect this as a price for 1% of the shares. I find that clients really like this model, and then it can be expanded for the different percentages that are being offered. So now we're going to look at taking the price, which we've completed. I'm assuming actually that we've identified the key employees who we're going to give the offer to. And the next step for us in designing an internal offer to sell shares is understanding the financing and how this price will be paid. I have a final poll question for you. At what stage is your firm in planning for ownership transition? Can we have the poll? Oh, the poll is running, yes. Oh, actually, I don't see it. Can we put the poll up, please? Poll number 3. Thank you. Wait a few seconds. Okay, let's see the results. Excellent. Thank you for those who have responded. This is the picture that we see here has been the picture that I've seen for the last couple of years. It's I see here, early stages of discussion, 40%. This is where a lot of firms are. I think that we're at a point, as I mentioned at the beginning, where there is a tremendous interest in this topic, and to understand the topic and to understand how it can be applied to your firm at whatever point in the life cycle of the firm that you're in. And I'm seeing that firm founders and owners are now looking at this idea much, much earlier in the arc of the life of their firm than I'd seen, say, the last 10 years ago. Things are really changing. So, and just a caveat here that thinking about early stages in discussion and exploration about succession doesn't mean necessarily selling shares now, or it could be in our model here in a couple of years from now. So part of the plan is the education. What can we do to start to understand the firm better, make strategic decisions, and as a group with some senior people start to get ready for succession and ownership transition. So let's move to the offer now. In order to understand and finalize what we want the offer to be, we have to understand how the employees who are buying shares can actually pay for the purchase price. So here, there's room for a lot of creativity. It's really important here for owners to really understand employees' financial situation. As we know, many are in the phases of their lives where there could be, mortgage on a home, expenses for a growing family, lots of financial restrictions potentially. Not common to see a lot of people with excess cash floating around to buy shares. And I don't mean that with any judgment. So there are scenarios where some have some cash resources available, but I'm seeing that quite significant number of employee purchasers are financing the purchase by line of credit, maybe asking the firm to organize something through its bankers so the employees can borrow from the bankers. And there's also a scenario where the seller can provide financing. I think what I see is that it's really important for the owners of the firm to show that you, quote, want to make this happen and express that to the employees. And these options are not mutually exclusive. It really depends on the nature of the purchasers, the percentage to be sold. And so I can share with you that there are scenarios where the seller expects to be paid up front in full. I'm seeing more and more scenarios like this, in fact. And so we're looking at these options here, the first three options here on the slide, as to what's possible, and can the firm be involved in negotiating with its own bankers to set up an employee share loan purchase program, and so on. So there's, as I said, a lot of creativity, and things are changing. It's this key thing about wanting to make this happen, and to also then teach first the owners and then the employees who are being offered shares, how this works. I'm going to move into that now. Where will the money come from? Where will the funds come from for employees to pay for the share purchase loan? Firstly, employee purchasers may receive a salary increase and possibly a performance bonus. Often do see a salary increase. The amount is really unique to each firm, but some bump in the base salary. Performance bonuses for shareholder employees varies. Some firms use these and some firms don't. It can be an interesting way to allocate profits based on performance that is different than the percentage of ownership. If you have very high performers who are buying small percentage of shares and so on. So these are used strategically and in certain cases. Then whether the employees expect it or will use these additional salary and or bonus funds net of paying personal tax is really something, it's up to them. These are part of their remuneration as an employee of the company. Do shareholders sometimes receive enhanced performance bonuses? Could be. So it's often not a requirement, but I have seen scenarios where the employees will use some of these additional funds to pay down the price. Once the firm has paid out the salaries and bonuses, and we have the profits that I've shown you in the dashboard and in the pricing model, the firm will pay corporate tax, and then it will distribute annual after-tax profits to the shareholders by way of what is called a dividend. Dividends would be generally paid to the shareholders based on the proportion of their ownership. I'm not getting into details of multiple classes of shares. I'm assuming a very simple scenario here, one class of common shares, all shareholders own their percentage of this class. So that is going to be a new flow of funds for the purchasers. Now, it's also important to note that the amount of periodic or annual distributions by way of dividend will be based on available cash from operations. The thing is, for a firm to be able to distribute 100% of its profits in the form of dividends each year means that their billing and collection cycle is incredibly tight. And it's often not possible because another factor that comes in here is the fact that the firm may be making investments in its own growth, hiring more people, as we saw in our case. Investing more in technology. We know that technology costs are now one of the top 3 costs after labor of the firm, along with occupancy and liability insurance. So this is where, as a group of shareholders, managing the cash flow in the firm becomes a group effort, and everybody's eyes are on this, and with certain responsibilities assigned. The dividends are usually expected to be used to repay the loan balance. So I've seen this included in shareholders' agreements, or maybe not as explicit, but generally that's the expectation. And then the dividend stream continues after the share purchase loan has been paid. The employees could be buying more shares, or they could, at this point, they may have reached the maximum and will now use the surplus as an investment fund for themselves. So we're going to now look at how that works. We're going to model the loan repayment scenarios under a few different benchmarks. So we're going to look forward now. We look to the next 5 years. I'd like to model this out over a 5-year period. So we're looking at 2027 to 2032. Yes. We go through this scenario and the modeling before an offer is finalized and presented to employees. The details may be shared later once there's some sense of commitment. This provides you a means to understand, firstly, how the stream of dividends can support repayment of the purchase price. And after you become familiar with how the model works, it really importantly can help you assess affordability and timing before you finalize and extend the offer. Employees, when they're further along in the due diligence, will want to look at something like this to understand how the financial planning and decision-making will work. There's more and more transparency around this, and we'll talk about this in a moment. So we're now in part 3. We're going to model the share purchase loan payment scenarios and arrive at the price that we want to include in the offer. So we're now in 2027, and we have 3 scenarios. We have the purchase price that we arrived at before in the work we've done. And we'll take our baseline at a multiple of profits of 1. So scenario 2, we increase the multiple that affected the price. Scenario 3, we increased the multiple, that affected the price. Now we have 2 more factors that we need to use in our model. What do we project the percent growth annually in the profits of the firm over the next 5 years? And to keep it simple, I'm setting a percentage, and we'll take that increase over the next 5 years to be, say, 5% a year. So in these 2 scenarios, I'm going to keep it at 5%, and then we'll raise it to 10%. We're assuming that with a 2 times multiple, the firm has a perhaps healthier profitability, and given the unique features of the firm, we can look at a 10% growth rate. So now we have to also say, well, we don't expect that we're going to distribute every single dollar of after-tax profit as dividends each year. We're going to hold back a reserve of profits to build working capital or cash reserves to fund investment and growth in the firm. So we're going to take these assumptions and run them through a model. Show you what that looks like. And I'm going to first run through what we have here and then talk to you about how powerful this exercise can be. It's a very creative process. You know, I often say I really look forward to this part because we've undergone learning at various stages, and we can now modify the assumptions and get a deeper understanding of how we see the value of the firm. So as owners, you can understand this before you'll come up with a methodology to present to your employees. So baseline scenario, price $23,000 for the shares. The stream of dividends, based on all the other assumptions, 5% growth a year, is $42,000. Personal tax will be paid on the dividends. I'm not assuming, in this case, I'm assuming that the buyers are buying as individuals. There's a different case if the buyers are buying using holding companies. That's very much tax driven. That's a topic for another session. So 15% dividend tax on the dividends, net cash from dividends, $27,000. Loan interest at 5%, which is prime, gives the employee net cash of $22,000. Then that means after 5 years, they've practically paid off the loan. Okay, what's our second scenario? The price is different, but the growth is the same, 5% a year. So the dividends, the flow of dividends is the same. Pay some tax, and the employee pays a little bit more in loan interest, and they're left with $22,000 cash receipts. And the loan balance after 5 years is down to $5,000, which is significantly low, about 20%. By the way, I'm not imputing tax on the loan interest because it's not a material number for this purpose. So scenario 3, where we've got the price at the highest level, we're boosting our annual growth to 10% a year. So we expect the dividend flow to be higher. This is after the 10% reserve has been withheld. Pay tax, where we got $31,000. Loan interest is close to what it was under scenario 2 because of the fact that we're receiving, although the purchase price is higher, we're receiving more in dividends, or paying off the loan numerically more quickly. So at the end of 5 years, our loan balance is $5,000. This is a lot to absorb. And when working with clients on this, we're actually into some of the details. But once we've agreed on the average annualized profit and the multiple and the assumptions on growth, we can start to change them around. Like, for example, if we wanted to change the growth rate, or if we wanted to change the reserve percentage, and so on. And it becomes something that we can circle through much more quickly, because as we change the assumptions, I find that the owners are they look at the price, And then they look at the period of time to repay the financing. And a lot of the detail is we don't have to focus on it as we go through scenario changes, because it becomes inherent knowledge over time. That's really powerful. So there's another really important aspect in the case here, because the fact is we have held back 10% of profits. We haven't distributed those profits each year. So they're building up in the firm in value. They could be invested in technology, as I said, could be hiring more people, could be a little bit of a cash reserve for volatility, and so on. So it will be reflected in the value of what the employee owns. And that's why it's important to show this now to employees as they're coming into ownership. This is something that I feel and I've seen, especially in the last, I'd say, 3 to 5 years, where this return on investment information in this time of greater transparency with employees is really important to express, because this is a firm that's very healthy and the return is very healthy. So not only, it's not just an investment, it's your life, it's your profession. And it would be, it's a very positive thing to see a return like this. Of course, understanding that this is a projection, and there has to be, some conservative aspect to the projection. So what happens here is the initial price of the shares here. And then after 5 years in 2032, we have an increase based on the 10% of annual profits that we've held back. This will, using the formula that we have, this will reflect in a higher book value. If the book value at 2027 was 1.5 million, if we had distributed all of the corporations, I'm assuming corporation or partnership capital, all of the profits by way of, in this case, corporate dividends, the book value would have remained at 1.5 million. But because we have retained profits, the book value is increasing. So we look at the change in the price of shares. The employee purchaser has not received this in cash. This is the total of dividends they received, and we do this calculation on a before personal tax basis. So this value sits in the shares. If they were to sell their shares in a formula, if they're using the same formula as it was used in the purchase, there would be a $7,000 increase in the purchase. So we have return on investment here in the 30 to 35%. It's a very healthy scenario. So, all right, now we've been through this. We've gone through a lot of different modeling. We've had a number of sessions. This firm, it has sustainable quality profits over time. And I wanted to use this as our first scenario. If I was going into a deeper dive, I could present different growth scenarios, more volatility in the profitability, and so on. So what we've decided is we're going to take scenario 2. We're happy with this. The owners are comfortable with this. This is going to be the basis for the offer, the $27,000 purchase price. And this is what it looks like. This is now our final for the offer. $1.5 million book value, 3-year average normalized profits for the last 3 years, 2024 to 2026, times a multiple of 1.5 gives us $1.2 million. Total value for the initial sale, $2.7 million, price $27,000. When I say final for the offer, I have seen scenarios where there is some negotiation on the pricing. The key here again is to get comfort. The modeling will likely happen a little bit later in the process, which I'm going to get to in a moment. However, with all of the, in good faith, with all of the analysis and learning that's being done, This is the price. So from here on, we are basically going to have a formal presentation to the employees, and we'll go through due diligence, where confirm the final interest, finalize documents, and close. So this is the graphic. As far as the timeline, it's really interesting. Those of you who have gone through this or are going through this, you'll know that the timeline, it can be a challenge to try to predict. We start with intentions. This is an organic, or someone mentioned to me the other day, a human. It's organic and human, this process. And I really believe over time, from what I've seen, is that it really takes the time that it needs to take. I've seen deals that were started just before COVID, deals that went through during COVID, deals that are now facing in the current volatile climate in certain sectors of the industry. These projects are moving forward, so we're reacting in real time. It could be adjusting the pricing for this first phase sale and so on. So it takes time. This getting to the presentation and then this due diligence for the employees to have the comfort to confirm their interest to purchase. There's a lot of interaction that happens. Let's look at that. So why a formal presentation? It's really important that this be treated in a way that is visual, provides clarity, is an open conversation, and the employees will take away something like this, a slide deck, which lays out the key components of the offer. I have noted up here, this is really important, that employees will have signed non-disclosure agreements before this initial presentation. This is something you work out with your lawyer. And my advice to people who are being offered ownership, if you're asked to sign what's called, we shorten it to an NDA, this is not an onerous request, because the firm is going to be sharing some information which is proprietary and highly confidential. And generally, you would be permitted to share that information with your advisors on the transaction. So high level dashboard of KPIs. We want to show the employees return on investment. The amount of detail you show in the first presentation varies. Perhaps you don't want to get into that yet. And again, here, the level of detail, if you're showing the firm's revenues and profits and so on, I will share with you, I'm seeing a movement to more transparency. If you've been talking to these people, or if you as an employee have been in conversation with the owners, the expectation, or it's cultural, it's personal, what expectation is there, and what are the owners comfortable in sharing? So I'm not going to present a draft presentation, because usually the front end is the owners themselves talking about the history and legacy of the firm. And then we run through scenarios like I've shown you in this presentation, picking and choosing the detail that we want to show. Then we move to, assuming initially there's a willingness to move forward, we move into due diligence. And this is the process that is very document heavy. And at this point, financial, tax, legal due diligence, the employees are asked to seek advice from professionals. They must have independent legal advice if they're going to be signing legal documents. And we are asking employees to seek financial and tax advice independently to give themselves comfort. So this is where we're starting to share a lot of documentation. The NDA has already been signed earlier, as I mentioned. Certain draft agreements are presented at this point. We've worked with the firm's corporate lawyers to draft a shareholders agreement, share purchase agreement, key risk considerations, promissory note if the sellers are giving back, are taking financing commitments, and so on. This process is very iterative, and there are periods of questions and answers and touchdown points and so on. So to move towards closing, basically after due diligence is completed and employees feel comfortable, we will receive confirmation from each employee as to whether they intend to proceed. And this can be unpredictable at times. There could be, I've seen all kinds of different scenarios. Some decide in the end, thank you, this is not for me, for all kinds of different reasons. It's not necessarily negative. It's a big deal to obviously to decide to take on ownership in a firm for all the parties. We answer any remaining clarifications, move to signing legal documents. We have had review for an independent advice and set a target for closing. Open, transparent communication through this stage is critical, and that leads to perhaps a more efficient timeline and so on. So we will close with the last piece of our case. The sale has closed, and we're very pleased. We've worked through this case where phase one of the firm's ownership transition plan was successful. Welcomed 3 new shareholders through building trust and value and a foundation for the future, next phases to come, and it's a really good outcome. So, yay. That brings me to the end of the formal presentation. We're at noon, which is where we wanted to be, and I'll leave you with some thoughts. Succession planning is more than a transaction. It's a process, it's alive, and there's a lot of learning and there's a lot of collaboration. We're aligning leadership, culture, and financial performance to support the long-term continuity of the firm or the plans of the firm. The architecture profession is evolving, and with thoughtful planning, firms can strengthen their internal teams while staying open to future opportunities. So what these future opportunities are, and perhaps preparing the firm for a sale or merger, as well as building the internal leadership, is definitely a possibility. I'm seeing this on the table in a number of scenarios. So we don't stop learning, we keep moving forward. So I'll just close with a couple comments. Please always consult your legal, tax, and financial advisors when considering succession or ownership strategy that's right for your firm. And so thank you to the OAA for the opportunity to share this presentation. And thank you all so much for attending and engaging in this conversation. So Claire, I see you're back on the screen.
Yeah, thank you so much, Elaine.
Okay.
And we have a few questions already coming through.
Sure.
And I know there'll be more. So I just encourage everybody while we get through the first few questions. Just a reminder, you can ask. It's a great opportunity to ask Elaine anything today. So much information in the presentation. I know somebody asked if a recording would be available. We are sending out the slides, and I think we will be posting it in a few weeks to our YouTube channel. But I know, having Elaine come back then to the area is a huge asset, and it's an ongoing conversation because the topic is huge, right? It's a really big topic. Okay, so I'll get through some of these first questions, and I know we've got some more streaming in. So we've got half an hour left of the presentation, but this is often where the rubber meets the road with people who have actual we're contemplating the issue. So first question from an anonymous attendee: do you include partners who are looking to sell shares in the revenue calculations? This would become more significant in smaller firms when the ration of partners to employees is lower.
Sorry, Claire, I didn't catch could you repeat that, please?
Yeah.
Your mic, oh, that's better.
Is that better? I'm
yes.
sorry, yeah.
Yes.
Do you include partners who are looking to sell shares in the revenue calculations. And the question goes on to say this would become more significant in smaller firms when the ration of partners to employees is lower.
Not exactly clear, because partners, the revenue of the firm is the billings of the firm. So I think, I'm not sure what the intention of the question is. It could be that maybe it's about the time that partners put into projects. I'm not sure. So generally, when we're looking at this, you're looking at the actual billings of the firm. So it's a little bit unclear. Maybe that person we can address this offline, perhaps.
Yeah, and some of these things are really like so context dependent.
Yes.
And you have to go through each, and I think that's the important thing. It's this isn't specific advice. You need to get a trusted professional to really know what works for each individual circumstance. It's like a general guideline, right? To be able to think about what the issues are. Okay, so Robert Martin is asking, would you normally ask for a down payment, say 15%? I don't know what specifically,
question.
but yeah.
Yes. So this goes back to this idea is the seller, are the sellers asking for all of the funds up front? So obviously, if they were, and the employees are going to borrow, that is a different scenario. Scenario that you're asking about, thank you, is that in the scenario where the sellers are providing financing for all or part, yes, generally, I'd say, yeah, 15%, 20% down payment on closing is not unusual. And that sometimes a bonus may be paid to employees that they've earned to help them at the time that they're buying shares. Yes, they pay tax on the bonus, but have some additional cash to put down on the share purchase.
Okay. Someone is asking if you could define what indirect labor is.
Excellent. So I had mentioned that this was one of the areas of caution when you're looking at comparing your firm versus other firms or surveys. So in some, depending on your project management software, if you've got a software that is tracking hours accurately, then it's an hours-based calculation. Out of an employee's total hours, what percentage have they charged to projects? And what percentage is going to other activities? Could be training, business development, firm administration, and so on. That would be indirect labor, the second component. So that's hours based. And then the software will do, it's a weighted average calculation. So takes all the hours and calculates a firm-wide utilization. Some firms are, if you have that information, are calculating this by employee position level. That's one way of doing it. The other way of looking at direct versus indirect is on a dollars basis, which is where it gets a little bit more complicated, because the line items as to what goes into direct labor in terms of professional salaries can differ. Do you pay for overtime or not paid for overtime? That's the big one, because some firms do and some firms don't. And so again, tracking your time, your metric over time is so powerful. So when you're comparing, that's why I suggest you compare the change in utilization over time in the surveys. Okay.
Okay, so, and again, I don't know if you can answer this question specifically because it might veer into advice, but someone's asking, when a firm is selling more than 50% of its shares, can it transfer its existing debt to the new owner, or must the original owners retain responsibility for debt?
Yeah,
Bit of-
that's tax, legal, yeah, that is outside of the scope of this presentation.
Yeah. It's definitely a good question to ask your trust when you're in that process. And it's
Yes,
so context dependent, right? And it's what you
yes,
agree, and so many other factors come into play.
yes.
Um, okay, so have you found it a common practice to increase income for employees purchasing shares, as you've noted in your presentation?
Yes, lately, yes, I have. I have. And at some point, when there's a greater disclosure, if we're like in due diligence, this would
Mhm.
be the time when the owners may share their salary levels, because as a group of shareholders, um, this is really important information about the firm. This is a highly sensitive topic, as you can imagine. So
Mhm.
if it is released, and often it is for transparency, will be much, much further along in the process. And it signifies trust on the part of certainly of the owners to share this information, and for the employees who are receiving it.
Okay, so this again might be a more specific question requiring specific advice, context dependent, but here I'll read the question. Maybe you can add some
Thank you.
thoughts to it. So in this scenario, you're a current shareholder and you're worried about the next phase of succession planning from the principals. Who would you go to review the shareholder agreement and tax implications of withdrawing from ownership and redeeming shares? In
Oh, okay.
what the shareholder agreement says, a financial advisor, a CPA, a tax lawyer. So it's who are your trusted professionals in that scenario is maybe a good way to look at that.
Yes, that's a great question.
Mhm.
That's tax and legal, okay? Because I know, I mean, I'm not a lawyer, and I'm not a tax specialist. I've seen enough transactions. The wording in the shareholders agreement about what happens if someone is selling under certain circumstances, there are different triggering events, lead to different outcomes.
Mhm.
So this person is bringing up a redemption. It's a highly technical tax. It's a technical tax and legal term. So
Mhm.
in that case, yes, and you need to consult with a tax specialist to help you understand the implications of doing it that way versus the other potential way, which is selling your shares to other shareholders.
Mhm.
And one more dimension on that question is, I didn't get into a phased approach. This is a topic for a more in-depth discussion as well. And the point in these phased projects where the founders or founder collectively are about to go below 50% is often a really important inflection point. And it could be, built into the legal agreements. It could be agreed to by the parties implicitly that, so let's take a look and review where we are at that point in the plan and reassess. It could be reassessing a number of factors. So that's also legal, it's tax, it's business, it's personal. It's often a good time to pause, depending on
Mhm.
the nature of the person.
Mhm. Okay, interestingly, this next question Robert is asking is about the 51% ownership requirement, and maybe I can also shed some light on it too. And
Yeah.
um, we were actually just talking about these provisions in the Architects Act. So can we discuss the 51% ownership requirement in relation to non-architects and others buying shares? So
So
I can say
go
to
first. Yeah, you go
yeah, the
first.
sections
Yeah.
deal with the issuance of a certificate of practice. You're right, Robert, that they do require 51% ownership, and you can see the section 14. Well, there'll be separate sections whether it's a corporation, a partnership, or an individual. But specifically for corporations, it's ownership requirement is tied to being a member of the OAA. So members include limited license holders such as licensed technologists as well. So now that we've changed the regulations, that would include those members. And it can look like a combination of members of the OAA and members of the association. So that's section 14 of the Architects Act, if anybody wants to review that specifically. So I don't know Elaine, if you have any other thoughts.
Yeah, I do. That's a perfect segue because this is what I'm seeing. Firms are definitely broadening the concept of who they're offering ownership to. I'm seeing interior designers as integral parts of the leadership team, landscape architects. This is not an exhaustive list. It goes on. I've seen senior financial people being offered ownership. So there's a lot of creativity around this. And so it's ingrained. I'm finding that the architects know about this 51%. It's like so deeply ingrained in many people's minds that speaks to this idea about starting succession earlier in the life, the arc of the life of your firm, so that your bandwidth as owners to when you may want to sell out as licensed architects gives you time and flexibility to manage this over time. So if you're closer to retirement, then you may find yourself in a scenario where you don't have as much flexibility, and that will impact your decision making.
Definitely. Okay, so what if someone's asking, what are the strategies for selecting employees to offer ownership to? And have you ever seen profit sharing in an architecture firm with all employees?
So there's two parts. The profit sharing part, yes, I have seen it. Profit sharing for all employees. It can be enhanced for not necessarily shareholders, but certainly people in more senior positions, and it can be enhanced for shareholder employees as well. What was the first half of the question, please?
What are the strategies for selecting employees to offer ownership to?
That itself that's a significant topic. And what I'm seeing now is that firms are looking outside for consultants, leadership consultants who can help them through that process. I've seen all kinds of different scenarios. There are consultants. There's a certain program out there that is available that some companies are using as a management development tool. So there are different tools that different consultants use. I think similarly to all like this financial modeling, understanding that perhaps this is something you want to step out of the firm for and get some advice on and support. Because in a good scenario, the team will work together and the consultant will work with the owners and the employees at certain levels for the employees, or maybe all the employees, to understand the skills that are there, the skills that are needed for the firm's unique strategy, and where the gaps are, and how, as a group coming into ownership, they can support one another and so on. There are just so many benefits that can be had. So I'm seeing, again, small firms, budgetary constraints. I understand it's challenging. But I'm seeing more and more shift to understanding the need for this to happen. Taking someone, these are people whose lives you're helping develop, and it's an investment. It's a really, really important strategic investment. And I'm suggesting to firms when they look at industry groups or, for sponsorships and that kind of thing, that it's actually not necessarily part of the marketing budget. It could be intentionally part of what you would call a professional development budget. So many aspects of leadership development.
Okay, another maybe just can comment on in general terms. How does compensation owed to employees, such as payment for overtime or long-term service, affect the firm's valuation when the company is being sold or preparing for termination?
Yeah, that's a very specific,
Yeah.
I don't have a broad answer
Hmm.
with you on, that's very transaction specific. So,
Is it fair to say that it would affect the valuation of the firm? That's something,
over time, I
is there a relevant factor
it
or?
depends, like, yeah, I can't say with certainty, like, it really would depend on how material
Mhm,
is and
mhm.
why that it begs questions. Okay, so
Yeah, yeah,
asking questions is the way through to understand
yeah,
why is this coming up, uh, what can we do with this, and so on.
yeah. I think the only thing I can offer is that like legally overtime payment could be a liability, right? So it's like any other liability of the organization, I suppose, on that
Well,
level.
payment over time depends because there could be what's called an earnout clause. I mean, we're getting into legalities and
Yeah,
specifics and
yeah.
tax issues. So
Yeah,
that's the
exactly. It's good. I
deal.
mean, it's a good like awareness building exercise
Definitely.
that these are the things that you have. It's a very detailed process to go through. So,
Yes,
really great questions, by the way. So,
definitely, definitely.
when would a firm put, again, these are really specific. So, when would a firm put their company up for sale to other firms rather than finding successors within their firm? I don't know if you can, if you.
I can speak to it because I'm having these conversations
Mhm.
live. And as I mentioned earlier, regardless of where the firm's going, if the firm wants to look for a sale or a merger, strengthening the leadership is going to be, if it's done properly, and then if the people are the right people and the mentorship, if things gel in a positive way, will add value to them, regardless of any other options. So they're not mutually exclusive. So that getting around that point is really important. So yeah, you may not offer shares, but by offering shares, if you're planning a sale in a couple of years or whatever, opens up the conversation, because where the conversation goes is because I've been thinking about this as a title for another presentation, is preparing the firm for a sale or merger transaction. So there will be some overlap to this topic, but it's different.
Mhm.
So there's a lot of interest in the community now. Firms are looking to purchase firms in other specific niche areas to complement what they're doing. There could be investors looking for firms because of the fact that technology and to help expand the firms. Like, this is changing. The rate of change in Canada is slower than in the US. There's a lot more private investment money going into architecture firms as there was in engineering, which is further along in consolidation. This is a rapidly changing area, and one that I know we'll be coming back to in the next couple of years, the following year or two, as it starts to evolve even more quickly, because there's a lot of interest on both sides. Just keep in mind that selling the firm is not a way out for your retirement necessarily, if that's what you're looking for. You
Mhm.
have to have something unique, and that will be perceived as value. It could be the founder or founders, so they would stay on for a period of time. It could be the leadership team. If there's so many qualitative and quantitative factors in value and the value range and so on, that if you go through these exercises of understanding what is unique and how you strategize to prepare. So we went through an exercise of preparing to sell to employees. There are many similar aspects if we're planning to look for a partner or to sell the firm. What is
Mhm.
unique? How would we look at value? And so on. So it's a very active strategic process.
Mhm. Okay, so we have three questions left in about 5 minutes, so
Yeah,
we'll maybe
try. Yes,
try to get them all in and say something meaningful, and then just a couple of closing comments at the end.
sure.
Do valuation principles vary for a full corporate sale of the firm to a new exterior, I guess, external purchaser?
That's a great question. If you speak with a certified business valuator and you're seeking a formal valuation, one of the first questions they're going to ask you is, what is this valuation going to be used for? What is the purpose? So I'm not going to get into the different types of reports that CBVs will issue, but the context is really important because valuations can be used in many, many different scenarios, not just the sale of the firm. It could be an internal reorganization. It could be a family law matter, and so on. So how the valuator will look at the transaction, if it's a sale of the whole firm versus a sale to employee, I can't speak for these professionals, but they would go through with you a pretty detailed assessment of what it is they're being engaged to do.
Okay, again, the next question seems like a really specific advice question, but maybe you can speak generally if this is something that you would even like contemplate and think about. So the scenario here is a small firm of maybe 5 employees with an owner. Often a large percentage of firm income could go to the main senior owner's salary annually. As part of pre-planning shares, do you recommend the main owner reduce his or her salary for a few years to boost up earning metrics?
Great questions. These are really insightful. So I would never suggest, I've had these conversations. I've
Mm,
had these conversations.
mhm.
So this goes back to, we're going to go way back to the beginning, or the middle part, normalizing the performance. So we take the financial statement profits, and then the first thing we look at is owner compensation. And we track it and we say, okay, it's at this level. If you're bringing someone in, are you underpaying yourself? Are you overpaying yourself? Like, where would you, relative to other people, where would you set and it's value judgment. It's not for me to say this is way too high. I can express, if they ask for my opinion, I can say, what often I am asked, what do you see in other firms? Like, this is really a common question throughout this whole process. And it does vary, but there is a band, there's a band out there that we see. And so it becomes a conversation. And sometimes I've seen it adjusted down. And sometimes I've seen it adjusted up because the owner may be, the opposite, the inverse of what this question, the person was asking here. And
Mhm.
so part of the exercise is for me to show the owner what their total compensation package is going to look like before and after a sale.
Mhm.
So whether or not they're changing their salary, that would be something interesting to look at as well. But if they are changing their salary, then it's because they may be giving up a bonus or, that extra piece. What's that going to look like?
Right. And then finally, we've got 2 minutes left on the clock. So
Oh, yeah.
where can I find KPIs for different sized firms?
Okay. What's difficult to find is really good Canadian data. That's the first thing I'm going to say. So that being said, there are a number of surveys out there. I look at the Deltec Clarity Survey, which came out in May. I know PSMJ does a survey. I think another one is it Monograph? No, that's not Monograph. There are others. So some, like I know the Deltec survey does include the data of Canadian firms. It's not extracted out. So again, bear in mind, if you're looking at US firms, the markets are very different. But what's really cool I find about these surveys is that there's a lot of good commentary about the state of the industry, and a lot of it is US focused. I think the AIA, American Institute of Architects, puts out stuff as well. So everything, again, in context, the trends over time, and understanding that we don't have a lot of detailed Canadian data. The RAIC, Canadian Architect Magazine survey, the benchmark survey that I mentioned, the 2023 survey, was a very deep dive into Canadian firms. So that's another good place for you to take a look.
Right. Thank you so much. And yeah, just right at time, I just wanted to announce for next week, we have another webinar coming up on the 7th of August. We're in August already. I can't believe we're halfway through the summer. And this one is a climate action, mass timber kits of parts, popular road junior public school. So, and I just wanted to tell everyone on the call, we still are extending the summer savings offer. So the OAA doesn't frequently discount, but we're offering webinars in the summer for the first time. So for those of you who need to get your Con Ed hours, it's a really good opportunity to sign up. So maybe after this webinar, you can sign up for those ones in August. As I mentioned, the participation will be noted in your transcript for those of you who attended 80% of the presentation today. And as we always do, we send out a link for a survey. So we really value that. I know Elaine would value any of your feedback. Just hearing the questions, I can tell that this is a really important topic. Again, it's the beginning of a very important conversation that we hope to continue with our members. And thinking about it, it's so wonderful to see everybody thinking about these issues. So again, thank you so much. Thank you. Have a wonderful rest of your day, and we hope to see you again soon.
Thank you. Thank you. Thank you, Claire. Thank you
so much. All right. Bye, everyone.
Bye-bye.